Hello guys, hello ladies. In this video, I'm gonna teach you guys how to map and spot out a perfect high probability liquidity strategy. And I'm gonna be showing you guys for free. One thing top traders, your mentor are not showing you yet. But in this video, I'm gonna show you for free. All you need to do is to click the link to subscribe and like this video, so you'll be getting updates on whenever I release a new video. So in this video, we are talking about liquidity sweep, the main fuel in the forex industry. So today, I bet after watching this video, your win rate is going to improve because we are going to do a lot of work here. But first thing first, what is liquidity? Liquidity is one thing that moves, or let me say that fuel the movement of the market. And liquidity is all about money. You can say it's money. You can call it a stop loss run or a stop loss hunt. But one thing about liquidity sweep, one thing about liquidity sweep is that the market barely comes to sweep and just starts going up or down. 8 out of 10 times, the market always causes manipulation when the price is at the liquidity area, which is by creating a fake moves on a lower time frame to trick retail traders. So the best way to trade liquidity sweep is by waiting for your POS or using the order block or the flip zone below the liquidity, so that your stop loss will be at the protected low or highs. So once again, liquidity is money and stop loss hunt. And again, I can say liquidity is what fuels the market. If you can't spot the liquidity, that means you are the liquidity. So in this video, I'm going to teach you how to spot a perfect liquidity sweep that will help you increase your win rate. So let's start. We have something like this. Let's start with the bullish. We have something like this. Yes. Oh, hold on. We have something like this. A sweep to this side. You can see there's a break of structure here. If the market, as you can see, the market is on a bearish phase. If this supply, because here it is, you can see here the supply area. If this supply were to do its job, the market will just come to this area and quickly move down. But the market started buying. You can see there's a break of structure here to the upside, which the market started showing interest in going up. And the market now comes down to this place and shoots up. If here were to be a fake move to the upside to trick the retail traders and sell even more, then the market will have gone down even further. But at this point, the market went up, create another break of structure, which is called a transactional liquidity. This is the market shift to the upside. This is a transactional liquidity, and this is what we call the structural liquidity, which is said to be an inducement here and inducement here. These moves are only meant to trick the retail traders. Those buying here will pull that entry here, put our stop loss around here. Those buying here will put our entry here and put our stop loss around this area. So unfortunately, the market returns down to this area and quickly shoots up. This is what we call the type 1 liquidity sweep in my liquidity sweep strategy. So here is the type 2. We have something like this. Like this. Sweep to the downside. Like this. Like this. I'm coming. This is being tricky. You have something like this. 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 And like this. You know, the market don't just move in a straight line, so I can't just do my illustration just that straight. The market moves like waves, so it moves in scenario like this: up, down, up, down, up, down, up, down, up, down, up, down, up. So this what we call the type 1 this is what we call the type 1. I hope you are understanding. If you are understanding, please comment, drop a comment on the section, drop a comment below. And this is what we call the type 2. So hope you are getting it. This is type 1, this is type 2. So in such scenario, let me break it down for you. The market is moving down bearish in this type 1 setup, as you can see. Please just pay attention and look closely. You will see what I'm doing. The market move down from this point, push up, react to this zone here on the left side, and push down. So you can see there is a break of structure here, which I call an inducement, because we are looking for a buy here. So when the market create this inducement and move down, so the market will to respect this zone. If the market is to be still on bearish fish, the market should have respect this area here. But as you can see, the market broke past this high, which signify that demand have started putting the orders in the market. Like demand have started stepping in the market. So you can call it a POS, whatever you can call it, but I like putting those X because I like puzzle. But since I'm showing you guys, let me just put BOS. BOS simply means break of structure. That's what we call BOS, called break of structure. So as you can see, the market now pull back and create an inducement. As you can see, I call it inducement, but the main term is what is called in a financial way, it's called transactional liquidity. Sorry, structural liquidity. So this era is what we call a structural liquidity. Let me just put X liquidity. It's not going to contain it. Let me just put S LQ T Y. So here is show structural liquidity. I hope you guys are understanding what I'm trying to say. Then this other side is called a transactional liquidity. So whenever there is a transactional liquidity, which is TLQTY, so whenever there's a transactional liquidity, the market tends to go down even more to take out this structural liquidity. Remember, whenever there's a transactional liquidity, which is when the market moves from this level to take this high, this previous high, that's what we call transactional liquidity. So after the transactional liquidity, the market is likely to come back to take the structural liquidity, because as you can see, there's an inducement here to induce, or let me say to trick those retail traders trading on a lower time frame. So if those retail traders were to take that trade, although they will say that the market has broken the structure here, we are in a bullish phase, the market now pull back and create another high, which means there should be a demand around this area. Then retail trader will start shorting, will start buying long, and target either here. As you can see, what happened, the market went down and take out this low, take out the retail traders, hit that stop loss, boom, they have lost like $1,000 or a couple of $1,000 around this area. So what I'm trying to say that buying at this area is not safe, because that's the structural liquidity. And remember, don't forget, whenever the market creates a structural liquidity, the market pull-ups to create another high, which is called a transactional liquidity. And after the transactional liquidity, the market is more likely to go back down and take this structural liquidity to go up even more. So how to catch this move? You can see there's liquidity here around this area. There's a liquidity here, and here again, after the market went up to this area and returned back down to this area, retail traders, before the market returned to this area, retail trader, we put our position here, trying to long from this area, target another high. But what happens? The market comes down to this and take out this low, and boom. So if you are trading without liquidity, you can see the market is bullish, but you have lost 2 trades, which will cost you a couple of $1,000. And the market ended up going your way. You smash your TP, but you have already lost because of how you entered and where you placed your stop loss orders. So here, what I'm trying to show you guys is how to increase your win rate and how to avoid being stopped out before the market even goes to your way. So in this scenario, there's a demand area here, there's a demand area here. So this is a failed demand area, which makes this low a protected low. A word, protected low. I always call my protected low P low. So I always call my protected low P low. So as you can see, the best thing to do whenever you see something like this and you see your inducement here, you see another inducement here, which is the structural liquidity, and you see the market went up to create another high to let you know that the bias is bullish. So when the market started pulling back, you are not supposed to look for an entry around this area. The best thing you should do, look out for this demand, this previous demand that failed to hold this market, which the market broke past. You can draw the demand because there's still money around that area. So you can draw the demand, but that doesn't mean if you draw the demand, if you map out the demand to this area here, that doesn't mean you should enter for a trade like this. That doesn't mean you should enter for a trade like this, because there is no protected low here. There's nothing protected around this area. So the protected low, which is the P low, is where your stop loss is supposed to be. So we can see the market come down to this place, take out the structural liquidity and tap this zone. The market might even come down like this, but I assure you the market will barely take out this low again, because this low has already taken out this low. So here is protected, here is not protected because there's no sweep here. So you put your stop loss here, the market might come like this, and boom, you are in profit. So it's just as easy as that. If you can't spot the liquidity, then you are the liquidity. So this does the type 1 setup. Or if you don't want to use the previous demand, you either use a fair value gap, because whenever the market take out this low and buy aggressively to the upside, it usually forms some other block here, or demand, or fair value gap. So the fair value gap should be around this area on the left side, around this area here, or the demand or the other block. So the reason why the market is coming down here to take out this low is to mitigate one of these orders, either the demand or the fair value gap or the other block. But the reason why I said you should use this previous failed demand is that so that you shouldn't be having multiple thoughts or multiple guesses if the market is going to mitigate the demand, or the market is going to mitigate the fair value gap, or the other block, whatever. So you should just, instead, we use this one like this, afford the stop loss here, give it some space to breathe, and boom, the market, you're already on profit. It's that you target 1 to 3, which I always do, like this, boom, you're in profit. So this is the type 1. This is all about the type 1 liquidity strategy. And here's the type 2 liquidity sweep strategy. And as you can see, the market is selling, creates new low, it pulls back, which is it pulls back, mitigate the trade supply here, sell even more, which in the buying phase it has already taken out this liquidity, which makes here a protected low. Why I call it a protected low is that the market has already swept this liquidity, so the market it will barely come to take this low again. So but as you can see, there is no failed demand around this area. There's just the market sell from here to this point, pull back and sell even more, and the market now buy to this level, but it failed to create a new high. So that's why I call it the type 2. It failed to create a new high. The market now pulls back to this level, then boom, you can see there's a break of structure here, which I call my BOS. Some people do call it market shift, but I call it BOS, which is break of structure. So as you can see, there's a break of structure there. The market didn't pull back. Instead, the market still went up even further to take this higher time frame high as the swing high to the upside. So like the market broke past this swing high, the market now started declining. And remind you, this swing high is where the transactional liquidity is. So as the market creates structural liquidity, the market now is going up to create a break of structure, which is called the transactional liquidity. And as you can see in this phase here, I've told you guys, after the market take out the transactional liquidity, the next point the market will be aiming is to take out this structural liquidity, which a lot of people do call inducement. So as you can see, there is an inducement and there was structural liquidity, which we call the stop loss hunt. So same scenario, retail traders will be buying long from here, boom, you put out the entry here, boom, like this, and then boom, the market put a stop loss here, and guess what happened? The market tapped them in, take out our stop loss, started moving even further. So this is what we call the old structural liquidity has been taken out. So what to do on how to get this trade? This one, there is no QMR, there's no feed demand here, only just protected low, which is the P low. If you want to use your pending order, maybe you will target the order block around this area or the demand around this area, like this, then put your entry around this area. But in most scenarios, this type 2 liquidity setup, if you are to use your pending order, you barely get your entry. As I say, the reason why, as I say, this level, there's a failed demand here, there's order block here, there's demand here, there's fair value gap here. So for you not to be having multiple thoughts on where the market is going to come, you will just use this failed demand that failed to hold this market here. So you use the failed demand as your entry. But as you can see, this level here, there's no failed demand around this area. Instead, the failed demand is instead above, so it's not that important. So what you do now in this type 2 setup, after the market swept this structural liquidity here, for you not to miss the entry or to miss the chance to trade this market, You wait for the market to break structure. As the market sweep this low, this turn out to be protected low. So you can still call it protected low, P low. So as you can see, the market sweep the liquidity and buy even more. So what you will do, we see the market create an imbalance here. Whatever imbalance, fair value gap, it is what it is. So you draw your fib level. It's above the 0.5, which is the discount level. It's below the 0.5, which is the discount level. So remember, I don't know if you know how to use the Fibonacci retracement. We don't buy at premium. We buy at discount. We sell at premium. So the market is at discount. So you can put your trade like this on a lower time frame, and boom, target your 1 to 3, and boom, you are in profit. You have made like 3K or $30,000. So we are done with this illustration. Let's go to the chart to spot out one of these. So let's go to code. So as you can see, we are on good chart. Yeah, ZAR USD. This is the 4-hour time frame, the higher time frame. The higher the time frame, the clearer the chart is. So as you can see, the market, first of all, you can see the break, inducement here, liquidity, a pullback, the new high, pullback, a new high, and the what? Pullback, which we call demand, then the new high. So as you can see, there's a demand here. The market pulled down to this level, react to it, didn't take it out, then failed to create another high. Then the market what? Decline to this level, which, as you can see, the market have taken out this low and this demand. If this demand were to do its job, the demand were to take the market to the upside, not to the downside. So the demand is what we call a failed demand. So I can map up my structure like this. Sorry, my trend line, as I always do. Map my X. This S signifies liquidity. So as I always say, whenever the market take out this demand that's supposed to hold the trade, don't forget it. We can call this the protected low. Don't remember, whenever the market takes out this demand that's supposed to hold the trade, it is called protected, because it's already taken out this liquidity and the market will barely come back to this area to take out this low again. So I will call here my P low. I will call here my what? P low. You can see. So now what am I to look for? The break of structure to the upside, so that we will know if we are on the right path or the wrong path. But as you can see, we have our first break of structure, which is BOS. Then after that, let me change this to black, because I think the chart is already mostly red. So let's change it to black so you can see what I'm showing you guys. So after the price break this high to create new high from this bearish move, which signifies that we are already in a bullish phase. So the market now pull back to do what? To create structural liquidity. Don't forget structural liquidity. And mind you, the market doesn't move in a straight line. I told you in the beginning, you can see some awkward movement like this, but ignore this noise. That's not what we are looking at. So after the market creates the BOS here, the next high taking is what? Transactional liquidity. And I've already told you countless of times, whenever the market takes out the transactional liquidity, the market is likely to return to take out this word, structural liquidity, which is the inducement to trick retail traders. So STQTY, if you are following up, I bet you might have noticed by now, SLQTY, which is my structural liquidity. So if you should be trading on a lower time frame as a retail trader, and this is what you're going to do, because as you can see, this demand is unmitigated and it's a valid demand. So a lot of traders, we put our pending order around here, give it a small little space for breaking, then target this resistance level, hoping the market will come and tap the order and move up to that way. But as you can see what happened, like I told you in the other side, as you can see what happened, the market reversed back and take out this low and started doing what? Started going up. So as you can see, but if you don't want to miss this trade, and you want to be at the right path, what you're going to do is to what? Map your previous demand like this. Like I told you, if you don't want to be having multiple thoughts where the market is going to come, either the demand here or the order block or the imbalance, whatever, sometimes you might not see the imbalance, sometimes you might not see the order block, you will just see some liquidating candles here that liquidated this previous demand. So as you can see, I mapped out my demand, then remove this retail traders position. Then what happened after the sweep? You can see what the market do. The market tap this zone. Remember, your stop loss must be at the protected low. So what happened after that? Boom, we smash our take profit. So as you can see, this is the exact same thing I just finished talking about in the other phase, but we are done with the illustration part. This is what we call the chart. So I want to show you on the live chart so you will know that what I'm showing you there is actually the main reasons why the market move. I call it the fuel. Liquidity is just the fuel of the market. So as you can see, we have smashed our take profit. So if you miss this trade, how are you going to get it? How are you going to get another entry? Like maybe you analyze the market and you get caught up with something else, and unfortunately when you arrive at the chart, the market is at this level. What you will do, you'll go to the lower time frame. You go to the lower time frame to look for your entry. That's after you've missed the proper entry. So I'm coming. I'm having a connection issue. So same thing on gold. So as you can see, so this is our test. Go to the lower time frame. I usually trade on the 15-minute time frame whenever I want to trade on the lower time frame. So in the 15-minute time frame, as you can see, the market has broke past this high, which signifies that we are bullish. So what I need to do now is to look for a what? A demand, like I always told you, a demand level or an order block, or where there's an imbalance. But judging by my perspective, if I match this demand, as you can see, I've missed the trade, but that's not the end of it. I will still look for another entry. Then the market started selling and declining from this level to this level, from this level. After the break of this high, which we anticipate our pullback, market create another low, create another high, create another low, create another high, then create the last low. But as you can see, the market take out the low, this high here, to tell you we are bullish again. Then bullish, then pull back. So if you map this zone at first and you miss your entry, that's not the end of it. You can still map this zone again, and what? Boom, boom. Is what you can see, the long juicy demand candlestick before this long bullish candlestick, which signifies we are fucking bullish. So, and you can see there is a manipulation here. There is all sort of demands here which were taken out by this long bearish candle, which makes here another protected low. So then what happened? But one thing about the lower time frame, whenever I come to the lower time frame, I barely use 1 to 3 because I'm already using the higher time frame order flow. So instead, I go for the higher time frame highs. So with this trade now, you can target maybe this high here, and boom, you have been able to get your 1 to 7. Very simple as that. So don't forget, guys, these are the only two main reasons why the market moves: liquidity. The market always targets liquidity, either up or down. The market always targets liquidity. If you can't spot the liquidity, then you are the liquidity. So this on good. This is our analysis. As you can see, they sweep from here, inducement, the structural liquidity, which was taken out after the market take out this transactional liquidity. And as I always spoke, whenever the market take out the transactional liquidity here above the side, the market is more likely to return to take this structural liquidity and keep going up. So I think where is that? Where is that my share? So as you can see, this is type 1, which I just showed you on live chat. So tomorrow we will hit the type 2. See you guys next time. Don't forget to like and subscribe.